Are you searching for high, reliable income in 2026? Today we are breaking down two dividend titans, Ares Capital and Main Street Capital. These are the two of the most popular business development companies or BDCs. They both offer yields over 9%. But you need to know which one offers the best dividend for the risk you're taking. By the end of this video, we'll show you which one is truly right for your beginner portfolio. So first things first. What exactly is a BDC? Think of a BDC as a specialized loan provider for mid-sized US companies. The BDC gives them loans and often take an equity stake. Now here's the exciting part for investors. To avoid corporate taxation, the IRS requires BDCs to pay out at least 90% of their taxable income as dividends. This means nearly all the profits generated from these loans flow directly to the shareholder. This is why BDCs offer those eye-popping yields, often much higher than regular stocks or bonds. But remember, high yield equals higher risk. BDCs are lending money to companies that can't get cheap loans anywhere else. The primary risks are credit risk. Some borrowers may default. Leverage risk. BDCs are allowed to borrow up to $2 for every $1 of their own equity, magnifying gains and losses. Interest rate risk. Most of their loans are floating rate, so if interest rates fall, their income falls too. The fundamental difference. Now let's look at the core difference between our two players. This determines everything, especially long-term investor returns. ARCC. Ares Capital is managed externally by massive firm Ares Management. This external relationships comes with a heavy price tag. A non-negotiable 1.5% base management fee charged annually on its total assets. ARCC currently manages a massive portfolio of around $27.9 billion. This fixed operational cost must be covered every single year, regardless of how the stock performs. This external drag pressures ARCC to take on more risk just to earn enough to pay the external manager and cover the dividends. Main Street Capital is managed internally. Their managers are employees of BDC itself. The structure eliminates that massive 1.5 external fixed fee entirely. Managers are paid salaries and performance fees, 17.5% of NII and capital gains. Main keeps a much larger portion of its gross income, making it significantly more efficient and aligning the manager's interest directly with the shareholders. Portfolio and credit quality. PIK versus equity. Their investment strategies also differ, affecting the quality of the income they generate. ARCC focuses on very large loans in the upper middle market. Their strategy is defensive, prioritizing first lien senior secured loans, meaning they get paid back first if a borrower defaults. The warning sign. ARCC relies heavily on payment in kind, PIK income. PIK means borrower aren't paying cash. They are simply adding the interest to the loan principal. As of September 2024, PIK made up about 15% of ARCC's gross investment income. This 15% is counted towards dividend coverage, but it's non-cash income. If that borrower defaults, ARCC loses all that accrued non-cash interest. Main focuses on the smaller, lower middle market. Their portfolio is roughly 70% debt and 30% equity investments. The bonus. This significant equity component provides two benefits. Lower risk. Main's non-accrual rate, that is loans not paying interest, is lower at 1.2% as of September 2025, compared to ARCC's 1.8% as of September 2024. Growth. The equity portion is designed for capital appreciation. When those businesses are sold, the profits are used to pay those popular special dividends, boosting your total return. The dividend. If you're buying a BDC for income, dividend safety is your number one priority. We need to check the dividend coverage ratio, how much net investment income they earn versus how much they pay out. Let's start with Main. Main is the monthly dividend superstar. They currently yield around 6.5% on their regular dividend. But when you factor in their reliable supplemental dividends paid out twice a year, that yields rockets past 9%. ARCC on the other hand pays a quarterly dividend. and their stated yield is consistently higher, often nearly 10%. ARCC's dividend is almost entirely covered by its net investment income, which is the most reliable source. The key difference is payout schedule, quarterly, monthly. Valuation, the price to NAV. This is the killer metric. Net asset value is liquidation value of the company. A healthy BDC trades around or slightly above its NAV. ARCC historically trades close to or slightly below its NAV. This means you are buying $1 worth of assets for $1, maybe 98 cents. It's a fair price. Main Street Capital, on the other hand, almost always trades at a massive premium, often 40% or 50% above its NAV. Why? Because the market loves that internal management and that monthly dividend. Quick beginner tips before you buy. Valuation. Always check the price to NAV. For BDCs, this is more important than the PE ratio. Tax warning for international investors. If you invest from outside US, like from India, you must file the IRS form W8BEN. This reduces the mandatory US tax withholding on dividends from 30% down to 25% under the tax treaty. You can then claim a tax credit for that 25% when you file your home country taxes, preventing double taxation. My final verdict and beginner actionable tips. As a young investor, I would endure the higher price tag of Main because its internal management, superior dividend safety, and equity-driven total return profile. A great fit for anyone focused on building wealth steadily through compounding over the long run. ARCC is a great high-yield pick for someone closer to retirement who needs maximum current cash flow, but Main is the better compounder. If you found this video helpful, hit that like button, subscribe to the channel, and tell us in the comments, are you buying ARCC or Mains for 2026? We'll see you in the next analysis.